The London Session Open, or 600 seconds of trading, as is also known here at tradecaptain.com. My name is Alejandro Zambrano and I'm the Chief Market Analyst of Trade Captain and also Amana Financial. Based out of London, I'm going to provide you guys with a quick update on markets such as Euro, dollar, Bitcoin, gold, crude oil, and the DAX 30. And today as well, we're going to talk a bit about the Swedish general elections that concluded yesterday, but we still don't know exactly who the winner is. The actual sort of end result will probably be published by Wednesday. There's not too much happening in the actual Swedish Kronor, but it's still good to sort of keep up to date what's going on. Okay, before we start, as always, I need to stress that trading financial markets unfortunately is high risk. As you probably have seen, a lot of the brokers in Europe are now publishing their results, and about 80% of traders that trade CFDs or Forex lose money. So please bear that in mind. Hopefully, of course, you watch this presentation. I can guide you and hopefully help you to be having better trading, really. Of course, this is made with an educational purpose. Okay, let's kick off, and we're going to begin with the euro. And this is the euro versus the USD, and you're looking at a 6-hour chart. Now, the market is still stuck. This is the low from May 29th, and then you have high here from July 31st. It's also the June low, really, from June 21st. So June 21st and May 28th, pretty much the same level at 115.06. Now, wage growth in the US was very good. The actual outcome was 2.9 versus 2.7 projected, and that's something that caused the dollar to gain and should most likely continue to sort of allow the dollar to gain. Let me explain to you why, but I just want to show you a chart. Let me see here if I can find it now. Here we go. So you can see the outcome was 2.9. We've been at 2.9 in February this year, and then it looks like October last year, and then we've been here as well in I think it is January 2017, and you can clearly see now how we're very close to breaching this level. Unfortunately, I don't have so much data to show you, but if my memory serves me right, then we have had wage growth of about 5% in the past. Of course, this was different times when inflation as well in general was much higher. So you have wage growth up, but it could also be on the back of inflation, right? And the key point is this, though: it's looking really good for the U.S. labor. They see this, they read about it in the news, and they're gonna say, well, the average is 2.9. You can give me 3.5 or more, and that sort of creates an upwards pressure on wages. Now, obviously, not everybody can go and say, give me that salary. It sort of depends on how easy or how high the competition is within the field. But in general, people are making more money. GDP is about 4% right now in the US. In the second quarter as well, was at 4%. And here we have wage growth picking up, which should cause the dollar to gain. So I am fundamentally fully accepting and betting on the idea, not betting because I'm not in this market here, but I'm betting on this market to head to the downside. And I think a break to 115.06 should really cause the market to go down to 113, take out 113, and then probably head to the downside. I'm not sure exactly how it's going to work, but you have a head and shoulders pattern as well. Head, left, right shoulder. And I think if we take out, not the actual trend line, because that's 15.28, but if we trade below here, maybe traders will sell, stop losses go about 116 or something like that, and then they'll target the downside. Now, I don't usually cover the Aussie dollar, but I did talk about it last week, and I even did an article about it. If you check out my Twitter at AlexFX00, I published this setup. Aussie dollar versus the USD. The market was, when I published Outlook, trading at 71.63. The high of the day was 72 that time, and you can just looking at this weekly chart, you can clearly see that if we take out this low here and this low here, should really allow the market to head to the downside. And surely that happened. The title was Australian dollar, Aussie dollar, USD could slump on strong NFPs, and you did see push to the downside here, and then like ice on the cake, you had some comments from Donald Trump to potentially add tariffs on the remainder of the import from China that don't already have tariffs. They had, I think they introduced 50 billion in tariffs initially, and then I think on Thursday last week, I think it was, it expired the consultation period to introduce tariffs on about 200 billion. And I'm not 100% certain if they sort of introduced tariffs on that yet. But that's not really what's relevant right now. What's relevant is that another comment from Donald Trump's camp said that, we might just add, another 200,000 tariffs on the remainder of the 200,000. And that technically means that all of the about 550 billion of goods imported each year to the US would have some sort of tariffs, and that would probably cause US economic growth to slow, and definitely China, and Australia's linked to China. So that really helped to push down the market like this. And this is a 6-hour chart, and now we've reached that level, clearly below that level, and I think we might go up to 71.50, but I am confident that as long as you trade below 71.70, 71.80, that this market is gonna move to the downside. Technically, it is allowed to go even higher without sort of ending the overall bearish downtrend. Last week's high is at 72.38, and technically we're allowed to trade all the way up to that level. The same way as here a few weeks ago, we went very, very strongly to the upside. Went very strongly to the upside, but then still the market collapsed. So this is, I think, what we can focus on. I think this is a better market to focus on, given the macro fundamentals, than focusing something like the euro. So here I suspect we can continue to head to the downside. Now, we have talked about the pound as well, and the pound is doing good in general. There's going to be an informal meeting in Germany. I didn't really capture when it's going to be, but it's going to be this month, where they're going to discuss, all EU countries are going to discuss Brexit. And sort of leaked comments so far hints towards some sort of further softening from the EU in regards to the deal. Now, the deal they want to do now is not about future trade agreements and things like that. They just want to conclude what they call the first phase of the divorce, and then afterwards, I guess they'll need 2, 3, 4 more years to sort out the rest, because these trade deals, they take 10 years, something like that. Obviously, it's more urgent now, but surely it's going to take maybe 2, 3 more years before they sort everything out, I would argue. So this is supporting the euro or the pound, and obviously take out the trend defining level at 130.44, then most likely we'll head to the upside. But for now, though, the market is a minimum trading sideways, big picture still trading downwards. So the idea I shared with you guys here many days ago is still intact. The trend is still bearish. This market can still move to the downside. Tactically, though, I'm not selling here myself because there's better opportunities. Aussie dollar is one of them. And what could change my mind then? What could make this more interesting? Well, I think the break here, it won't necessarily be a head and shoulders, because the market moved all the way up here, but it clearly sort of breaks this sort of sideways price action and could, I think, hopefully cause this to decline. This is a target derived from head to neckline. Again, I wouldn't call this a head and shoulders, but there's still sort of gives you some indication at least what to anticipate. because the volatility you've seen in the past tends to be followed. So this volatility regimes like this one sort of tend to stick. In other words, we decline here very easily with 244 pips, so it wouldn't be unsurprising if we decline again with 244 on a break to this level. Bitcoin. So Bitcoin, you know, guys, it's time to, I think, probably time to look to short, as I mentioned last week. I'm not 100% certain that is the best thing to do, but it surely looks like we're heading towards that. So this is a descending triangle. Very straightforward. We take out the low, the market tumbles. The different ways of projecting targets, I decided to go, so the difference between here and here is a 40% decline. Difference from here to here is a 40% decline. Key point is this though, like whenever and if we trade below here, is that risk reward ratio. So obviously if the market would decline today with 10%, that would require 657 pip stop loss. And we could potentially make 2,000, what is this, 2,329. So 2,329 divided by 600. That's a risk reward ratio of 3.8, which is not that great, but it's very good. Still good, sorry. Let it go down with 5% today, and then maybe next week the market breaks. And suddenly you're dealing with stop loss of maybe 350. So again, 2,329 divided by $350. Now that's a risk reward ratio of 6.6 times the money, which makes this really interesting because we don't even have to go all the way down. You know, we go halfway and we get a decent 3.3% risk reward. It goes a little bit further, you get a 4. A little bit further, you get a 5. And if it goes all the way down, you get 6. So this is a very, very classic pattern. We've seen it in the past in the likes of Litecoin. Here, same pattern. Market breached on June 20th, 11th of June. And this just goes to the downside. Very similar. We've seen similar patterns in things like the Russell 2000. Here's a ascending triangle, which I traded myself. Not the full move, but parts of it. You got the same pattern, but to the flip side. Took out the high, the market just rallied, and we almost reached our target. Has taken a long time, but almost reached our target. So in general, I think the case of Bitcoin, I would rather be bearish than bullish. But let's see what happens. Are we going to break 5,771 or 7,429? Bullish, bearish. Next market is gold. Now this is gold, and as you know, I've been bearish for quite some time. And what I've done now is I just reduced my trend defining level. The idea was to sell here, and the market moved up, moved all the way up, then all the way down. We're in a tiny bit of profit. I have now reduced the trend defining level to 1210, which is the level down here. I think there's no reason to change the bias. If it goes up, I think traders are going to sell. And what you're really looking for now, and what bearish traders are looking for right now, is a break to this low here from September 4th. Take that out, and you'll see that acceleration of the downtrend. Now, I would not call this a head and shoulders, but it has a little bit of that tendency, head, left, right. And again, I wouldn't really call this head and shoulders, but it does suggest, if we just follow the geometry of this market, I guess break the low, we could go down to the low down here. So I think that would be perfectly reasonable. What's also interesting, you have the same pattern in the euro dollar, same pattern in the pound dollar as well. Here's crude oil, and crude oil last week, was bullish on the way to the upside, and the market did not go down so we can get a good risk reward ratio entry. And so we just got that breakout, and then within 24 hours, we've been stopped out. Oh, that bullish trend was over. And then I said, we're probably going to decline. And we had 3 days of decline. The market declined with $2.50, 3.5%. And since then, the market has stabilized a bit. Now, if you look at this market, it's just trading sideways within this triangle. And I guess at one point, we might have a break here to 71 or a break to this level here at 64.47. And we'll have a very nice trend to trade. But can't see that happening anytime soon. If it follows this, what I think is going to do is probably going to go up, then probably going to go down, and then up. And what will happen is that at one point I'll be able to narrow these lines down, and we'll work with a tighter breakout, and that's going to be better from a risk-reward ratio perspective as well. But for now, this market is trending sideways, so there's absolutely nothing to do here. Now here's the German DAX. German DAX is doing what I was hoping for, and it's slowly moving towards our target. The idea was break the June low, traders are probably going to sell with stops above the September 5th high, and since then the market has moved to our advantage. If one is short here, you should be up with about 161 pip versus a risk of 126. So getting more now than what you were risking. Now the game plan going forward is just to manage risk. That's what I would have done anyway. I think it may swing to the upside, but as long as you trade below Thursday's high, which is pretty much 12,102, I suspect traders are going to sell. So it might go up a bit, but I think traders are going to sell. I think stop loss is going to be above here, maybe at 12,141 or something like that. So by doing that, we have dramatically reduced our stop loss. And then it goes up, and then it goes down a little bit more, and then we can reduce the stop loss further. Now, I'm actually not short this market. I'm actually short a different market, which is the Spanish stock market. It's called the actual name of the market is IBX 35. I think it's, and this is the market. And I did an article for you online as well. Published this last week. I won't be able to find it right now. Let me see. It doesn't matter. Actually, no, not here. Just keep an eye on my Twitter. I don't publish too often, so you're not gonna be spammed. Anyhow, you see here, ascending triangle. So low, low, took out the low. I went short last week, and if this just sticks to plan, then this market would decline with about 7%. Sort of depends on, I don't remember exactly how I draw it the first time. I think I did it from here. Down. And here you have the December 2016 low, which is a reasonable target as well, without any sort of patterns. I think this break here opens up for this. So this is something I'm short myself from the breakout level here at 9,334. Market here is going to the upside today, which is perfectly fine as long as it doesn't go all the way up and gets me stopped out. Beauty of this pattern is that I'm looking to make, I think with I had a 2% max loss, and if this works really well and goes all the way down to the bottom, I'll make about 15.5% return. So 15.5 divided by 2, that's a risk-reward ratio of 7.5. It goes all the way down. But if it doesn't go all the way down, you know, I wouldn't mind getting out at a 10% return. I mean, I think that would be good. In fact, I've done that many times. You know, you get up about 10%, and I book profits. But to be honest, most of the time I don't book profits because I get a bit greedy. But taking 10 profits, 10% here, 10% there, sort of is. It's a good idea. And I'm talking 10%. It's quite a lot, actually, if you think about it. It's more about the ratios here. I risk about 2% initially, and then get up to 10%, sometimes 15%. So it's all about these risk-reward ratios. Now, one person could be, you know, risking 1%, and then they would make 7%. or they will risk 0.5% and they make 3.5%. That's most pros and big funds. They'll be about 0.5% risk per trade. Why? Because they usually manage institutional money, and it's like insurance companies, it's pension funds, and these sort of funds, they have long-term obligations, so they need to pay pensions maybe 20 years down the line, and they want to see steady growth, 10%, 15% per year at most, with minimal drawdown, maybe 4 or 5% at most. They don't want to wake up, have a 20% drawdown or something like that, which is something I have experienced, and it's just because of the leverage and the risk I'm using when trading. Okay, obviously Spanish stock market is going up today. German DAX is not going up today. It's not doing too much. I think in general we see more of this sort of risk off. Indian rupee as well is down quite a bit. So I think we'll see more of that, and because of that, I wouldn't be positioning myself to be long the US stock market indices, at least not right now. You want to wait for some sort of reversal. Okay, now, so we're going to just talk a little bit about the general election in Sweden. So there's 6,004 districts, and they have counted pretty much all of them. There's 6,002 that are being counted, so we're missing 2 districts. And the difference between the center-left bloc and the conservative bloc, the right bloc, is 1 seat in the Swedish parliament. So the difference between them is just 1 seat, and I think in number of votes, we're dealing with about, I think, 30,000 votes. Now, people that have voted outside of the country, so expats, their votes are due to be delivered on Wednesday. So on Wednesday they're going to be delivered and counted. They're probably delivered already today, to be honest, but the actual results should be out by Wednesday, which means that it could be that's gonna affect the outcome, because the Social Democrats and the left and the Greens, they used to have been governing up till now, or actually as an MP Green, but they're missing, and they have 1 seat ahead of the second biggest party, which are I guess the Tories, the Tories of Sweden, and we'll see. I think in the case of the actual currency, we haven't seen too much action. The Swedish Kronor has been gaining slightly, but it's not a lot to talk about. Sorry. I guess if we see patterns like the patterns we've seen in the past, then expats will probably be voting on more right-wing or conservative parties. So it could be that we might have a conservative government in Sweden. The tricky part here, and why everybody is focusing so much on this actually, is because of this party here. The third biggest party in Sweden right now, and they're called Sverigedemokraterna, and they are a party which is anti-EU, anti-migration, and unfortunately it also has its roots in neo-Nazi parties. So that is obviously something that you've seen a surge of that across Europe, and that is obviously something that is, something we're seeing, and they could potentially govern with the conservatives. Not on everything, of course, but on something. So we'll see what happens. I think their actual impact is already evident. Like, both of the biggest parties have already gone quite tough on migration. And they will probably just continue to go tough on migration, even though in Sweden right now, I think unemployment rate within people born in Sweden is about 3%. So they're doing really, really well right now. But we see more sort of anti-migration. And yeah, but we'll see what happens. I think in the case of the currency, if Moderaterna and the sort of conservative bloc wins, you probably see slightly stronger Swedish Kronor. Now here, if you look at this currency pair, we don't have any pattern to trade that. This is heading to the upside. And the number one reason for that is that interest rates in Sweden are very, very low, even though the economy is doing very, very well. And eventually, I guess that we need to do something about it and the Swedish Kronor is going to gain. But we're not seeing any interesting pattern here. If you look at the dollar versus the Swedish Kronor as well, you don't actually see any sort of solid pattern. This is moving to the upside, and primarily because of what's happening in the US. There are, however, interesting patterns, and this is one. And here is the Norwegian Kronor versus the Swedish Kronor. Here, you did have a ascending triangle, which at one point was suggesting further gains, so further losses for the Swedish Kronor. And you can have that sort of push, but instead we had a failure on this pattern and the market took out this line here. Now it's usually not recommended to trade anything that has a slope. Ideally, just trade horizontal patterns. That's usually the best. So I'm not gonna get involved here myself with this market, but looking at it, it does suggest to me that as long as you trade below 108.46, that we could potentially see a further move to the downside. Now, I'm not actually fully sure if you can do what I'm doing now, because I never really trade failures of patterns like this ones. But again, if it would sort of follow the dynamics we've seen in the past, then maybe we'll have a decline to the downside here. So this could potentially be something. This would be a risk of 82 pip versus potentially make 279 by 82. That's a solid 3.4% risk reward ratio, which is definitely well considered. The only problem though is the quality of the pattern. Again, I think maybe we'll have a conservative government. I'm not sure, but if anything, I mean, both parties are open to potentially govern across the bloc and create something maybe which you will see in Germany, which is an economy or sort of political leadership which is not centered around one big party, or rather several small parties that control. And what happens is that you get less extreme sort of ideas to the economy. It could be good, but it could also be less good. And I think traditionally it tends to be less good because nobody really feels that they're better off. So, I mean, if this continues and if migration continues to remain lax in Sweden, then it wouldn't surprise me if Sweden Democrats by the next election in 4 years maybe even get a higher turnout than they did this time. We'll see what happens. All right, let's see if you guys have any questions. If not, we're gonna wrap things up. Okay, so we got a question from Mr. Bald. What do I think about the Australian dollar versus the New Zealand dollar? This is a good question. I can tell you about the technicals, but I haven't really followed the fundamentals for some time. Last time I checked, both central banks are in no rush to raise interest rates. That's what I can remember. I'm just looking for the pair. Here we go. So let's focus on the technicals first. So the technicals are telling something interesting. So it's telling me that the New Zealand dollar in the long run could potentially lose out. We're seeing this, and this is a weekly chart, by the way. This is a ascending triangle, and again, take out maybe 113.14, then you'll probably see this market head up with about 10%, and we'll be trading at 124.42. But that's on the break to this high. If you look at this, we're stuck within this range, and there's not much happening here. Very difficult to say be long, be short. Now, if we look at the daily, you see this level here, which is 108.44. Then you have another low down here at 106.55. Now, I wouldn't necessarily call this a head and shoulders, but it does show the tendency of a head and shoulders. Now, I don't actually think we're going to go all the way down here to these levels, but even without no patterns in place, I think 108.44, take that level out, and I think this could trade slightly lower. Maybe you'll see a 144 pip decline or something like that. Otherwise, I mean, I think the way this looks like, it will remain trading sideways for another, I think, at least a year. There's talks that maybe by the end of next year, maybe I think it was the Australian Central Bank, they might look to do something about interest rates at that time. But that's sort of the timelines we're looking at. So nobody's gonna take strong positions in this cross until, I think, one of the central banks starts to look into increase interest rates. And there's probably gonna be just one central bank, maybe 6 months ahead of the other one, sort of indicating they're gonna raise interest rates or something. And then you'll see maybe higher Aussie dollar or higher New Zealand dollar. And then literally 6 months later, you'll see the other one doing the same, because their economies are very well knitted together, so they tend to move in tandem. But the way this looks like, in the long run, we should be betting on the Aussie dollar, but that's only on the break here. This thing is probably going to continue to trade sideways for longer. And you know what's really interesting? I remember some Aussie guys I used to work with, and this guy, they were buying down here in 2014 and 15, because after this decline, they were very, very sort of, they were like, this is wrong, this does not make sense economically. And obviously they're from Australia, so they have a good view on what's going on over there. They talk with friends and families and so on. But just because something is cheap or out of line doesn't make it an easy trade, for the market just to bounce back up. Usually what happens is that you need some sort of a catalyst to get things going. Even though, maybe we all know that things are going to work out and it will go to the upside, unless you have that catalyst, it will continue to trade sideways for this for longer. And I think if you were buying the Australian dollar versus New Zealand dollar, you would still pay quite a lot of rollover. And I think at the end, this guy had to close out his positions. Okay, I'm gonna wrap things up, guys. Don't forget to hit that smash that like button. Just click on the link and then click on like down here. I have no single like so far. So guys, help me out as well. Don't forget to follow me on Twitter. I'm sure most of you guys already do that, but if you don't, then follow me on Twitter. And as well, don't forget to check out the Trade Captain Twitter, which is a Trade CPT. My handle is AlexFX00. So check it out. And don't forget to like and retweet my tweets as well. Guys, thanks so much for watching, and I'll see you guys tomorrow about the same time here at TradeCaptain.com and in the live training room. Thank you.